and they go through that as well. But it's all about finding a certain supply-demand zone that's tradable, essentially. But there are three rules that'll make an order block valid, because if you look here, you can't just use any random order block. This might be an order block for someone if they think it's an order block, but then they get fail, then they get their stop loss hit. So there's a little bit more to it, and we'll go over that now. So as I said, not all order blocks can be used blindly, and there's three certain rules for them to be valid. So one of them, you have to have imbalance in your order block. That's inefficiency in the market due to its impulsive nature. So, for example, and you probably know what imbalance is, but if we have an order block here, for example, which is a good example, we have this gap, and that's our inefficiency. And that's really important, because that inefficiency is straight away telling us that we didn't actually fulfill these orders, we didn't capture them and then continue on. And what that does, that creates this inducement below in which we can break, and then if we get a reaction from there, we have a tradable zone here, and from that tradable zone we can take a trade. So it has imbalance, has that detachment from that order block that we're interested in looking at. Impulsive as well. Well, if you're using an order block like this, for example, it has to break structure in a way. You can't, if you have an order block, you have a bunch of sellers at a singular point, okay? And if you're trying to use an order block that fails to even break structure, like it does below here, you might get a pullback from it, which is also tradable, if you want to do buys from a pullback, but you won't get a reversal, and reversals are the ones that create the biggest move, and give the most money in the trade, but they are hard. Reversals are hard, and they're highly manipulated. So it's all about finding that manipulation. So we have imbalance, which is that detachment from the order flow, and that impulsiveness where we break structure, and our final one's inducement, which is the most important. So if you're a bank, for example, and today, okay, you know, we're in a downtrend and we want to look to sell as a bank, okay? Well, we're not going to sell from anywhere, you know. If we're following order flow for here, we're not just going to sell here. We have to take a certain amount of contracts out of the market to be able to actually do a sell. So what happens is, so I'll just let this go in. So what happens after that detachment, we have this compilement of orders. And what that's telling us is that we're mitigating price. Like supply, as if we're supply here and we're just mitigating supply zone. But what's happening, it's actually collecting a bunch of orders, because, you know, if you put it like this, there's a lot of sellers here, there's sellers here, there's sellers here, and they're all respecting supply. Let me just delete that. So they see that, they see they got a big mitigation chain, and, you know, there's no imbalance here, everything's being filled up. So what happens is they use this whole mitigation chain as liquidity. And then after we tap past that imbalance, past that horizontal level of imbalance, then we can look for our manipulation. Well, why is that our manipulation? Because we're taking out people who are not following the manipulative order flow. So here, we would have started with a big sweep of liquidity. We got buy side, you know, liquidity here. And we have this big up move, and then that down move, that big V-shaped move, telling us we're taking that money, and then we're reversing instantly. So there's a lot of sellers here in the market. We mitigate that level, that selling level, always sweeping liquidity to mitigate, and then we have this level, and then we have that imbalance, and we have that impulsion, like I said, because we broke structure, and we know there's a lot of orders resting here. And then we have this inducement, and you can see the inducement as the end of the mitigation cycle. Just want to reiterate, it's a mitigation cycle because there's no imbalance being left here. So a bunch of orders already being used efficiently, creating no gaps. So what happens, once we break the start of the mitigation cycle, like we did here, you can't use an already mitigated zone. You can't re-mitigate a zone, a valid zone. So once we break, and we have that last point of supply, we zoom past, and we take out that whole mitigation cycle. So that's why the inducement is needed for the order block. It's very, very important to have inducement. It's the way we can find our potential manipulation for our reversal, okay? So we have imbalance, have impulsiveness, and we create inducement. In this case, it's a phase 1 inducement from a 5 or 15 minute plus order block. So I'll go over the two-phase theorem in another lesson a bit more, because it's a little bit more advanced, but this whole idea, where we're finding this as an accumulation, this horizontal level, is our phase 1. So we need to have that phase 1 and those other two rules. And there's some order block tips as well that are really beneficial. So order blocks that sweep liquidity are often a high probability. So let me just reiterate why this happens. So if we have a big move like this, and then we have something like this, okay? If we're taking this liquidity here, we're sweeping, and then we have this order block that forms here, which is a playable sell from here, for example. What it's telling us is that, well, this move swept liquidity, so this is that pure manipulation. And the whole kind of idea is that we want to play from that pure manipulation. And that constantly is happening. So we might have a little move here, and then another big move. And again we sweep. And those small sweeps make up those manipulations where we can play from. And we only want to play from those because they're the ones that are purposely taking out the micro accumulations within the leg, and then mitigating down. And then you just keep playing from those manipulations until you get a reversal on the other side. So let's go to this idea. So it's the 3 rules. We want to follow these 3 rules. So here, for example, we're breaking structure of a higher time frame leg. So this is our last, supply that broke that structure. And then we create that imbalance. So we create that detachment, telling us that there's a lot of sellers in this area. So you want to respect it as a zone. Now here we came up, and we nearly filled the imbalance, but we didn't. So we didn't actually efficiently tap into our zone. And what happened, like I said with inducement, you have that compilement of orders. See, we're mitigating down those orders, leaving no inefficiency. And then we have this big wick move up, and that's our manipulation. So this is on the 2-hour time frame or the 4-hour time frame, one or the other. But essentially, once you find this, it's like a little checklist of rules. But once that checklist ticks off as a manipulation, we can play our phase 2 inducement from that zone. So just give me one sec. Yep, so once again we have the 3 things. We have impulsion, imbalance, inducement. And it's they're all 3 I's. It's 3 I's, so it's kind of easy to remember. But it's really important to use them if you're looking for a zone to play from. So here we kind of got a kind of networking idea of how we use order blocks, kind of a step-by-step. This stuff, the darker stuff here, is what we'll go over in the future. And that's kind of getting a bit more specific with that mitigation, after that manipulation. But the first thing we want to do is locate high volume orders. I'll take you through it with the diagrams. So let's say we got this, okay? We have a big bullish movement, we have a sweep, we have a push up, etc. So there's a few order blocks in here, and we got to find them essentially using this idea. Do any of you guys have an idea where the order blocks might be, a good order block? I'm not sure if you can annotate, but you can just type it. Just say this is 1, say this is 1, say this is 2, say this is 3 for buyers. What do you think, 1, 2 or 3? 1, 3. Okay, so we got 1 and 3. Okay, how about for sells? If we're looking to do a sell, would you sell from here? Would you sell from up here? We'll say this is 1, 2, and then 3. 1, 2, 3. What do you think about that? 2, 2, 2. So this one. Okay, I like it. Alright, so let's follow our rules, okay? So firstly, we got to locate high volume orders, okay? And we got to find their active areas, so their cores. So where they're active, where they're ready to get mitigated and then have that reaction. So let's have a look at this. So this bottom here is here. It's just zoomed in, zoom out a little bit more. But we react to that demand zone. So that money from the orders previously have been transferred to this singular point, okay? But what I'm also seeing is that we've mitigated these buyers here up. See how there's no inefficiency? Everything's efficient. We've taken the orders and we've moved them up. And the same thing happened here. So we reacted from a higher time frame supply, swept our inducement level, and then we reacted from that, broke internal structure. But we can also see that this is all mitigated. We had a micro sweep in here to pick that. That had a little sweep over there to grab that, and it's moved up to this point as well. So using that mitigation can really tell us where the orders are, and that's the first thing we got to do. We got to find the high volume orders. Okay. So the next thing, we mitigated the money to this point, and we mitigated the money to this point, just using what we were saying here. So we had no inefficiency here, and I drew out some demand zones so we can connect the dots of how that money is moving up. And the same thing with here, we mitigated that, transferred that money transferred to there, that transferred to there, to this point as well. So I like these zones because they're following that money pattern, but they also have imbalance, so we'll get to that right now. But the next step is validity by the 3 rules through the fractal time frames. When I say fractal time frame, I mean if you have a 4-hour zone, you'll have a 1-hour reaction. If you have a 1-hour zone, you have a 5-minute reaction. It works through a funnel, but I won't go too much over that today. But otherwise, we need to find our 3 rules with our order blocks. So we found where the money has moved to, here and here. Here and here. And now we want to put in our 3 rules. So we'll start up here. That should be a number 3, and that should be another 3. Apologies. So we've got to ask ourselves, have we got the 3 rules? Well, number 1, we got imbalance, because we detached from the order flow of money from our original supply, creating that gap, that detachment. Inducement, we created a mitigation inducement, so that mitigation cycle, because it's efficient to this point. Price did that mitigation below our POI to collect more orders, okay? And the impulsiveness as well. Well, this move broke a demand structure. We had a nice internal demand in there. That's the last point that's responsible for that move before that imbalance occurred. If we look here as well, we have imbalance for this zone, which we can refine to this week as well. And yeah, we detach from that order flow. We have that impulsiveness because we broke structure there. So we swept and broke structure. It's a very good sign of bullish strength when you sweep and you break stronger swing structure. And we have inducement. So remember I said this level here, which is above that imbalance of our POI, that mitigated to there, this mitigated to here, okay? So our main idea is that if this is all mitigated, we're going to take it out. We have to mitigate it all first. That's the most important thing. But looking at this, we could say, well, if this needs to be mitigated, okay, maybe we can mitigate up to here and then go down to this zone that we have, which will in turn take that inducement that we need. Then we can look for buys off here and sells from here. So let's have a look at the next step. So we want to mark our phase 1 level. We want to mark the premium and discount of the higher leg. And we want to decipher what order block type we want to use. Okay? If we don't, sorry. Yeah, did you want to ask something or?
Yeah. Is that flow chart available to us?
Say it again, sorry.
Is the flow chart that you're using available to your members? Because
yeah, Sorry, yeah, continue.
I didn't see it on the PDF or anything like that, so I'm just asking, is it
Yeah,
available
for
to
sure.
me?
Yeah, so I'm
Hello?
record. Yep. Can you hear me?
Yeah.
Yep. So I'm recording this, so you have the recording, but I can also share this whole like document that I made. So I'll just share it through, so you guys can have a look at the document. Okay.
Yeah. I'll appreciate that a
That's
lot.
alright. That's alright. So if we don't follow those three rules, our potential zone, so a potential zone might just be part of that inducement chain. So we've got to make sure we follow those three rules. Okay. But yeah, this is the next point. So let's have a look at that. So yes, we follow our three rules here, and we follow our three rules here. So now we got a high and a low that's been established, okay? So this is a strong low because we know it's swept liquidity, and the same here. It's carrying those high volume of orders from the demand and from the supply from a higher time frame. So we draw from the top to the bottom, and we get our 50% level as well. And you probably know about premium discount, but it's a very strong tool because it teaches you a lot of patience and especially validity of order blocks. Because if we're in the discount in the bottom 50%, we only want to buy, and if we're in that premium, we only want to sell until we've used up that leg. Okay, so is this in the premium? Yes, it is. Is this zone in the discount? Yes, it is. So that ticks another box for us to say it's valid. Okay. Now refinements using time and price. Okay, so just skipped ahead, and this is how the trade went out. So we swept that phase one inducement. It's New York Open, so you've got to make sure you follow time and price. You can't trade at random times during the day. It's a little bit different for crypto if you're a crypto trader, but a little bit more forex focused with time and price. You shouldn't trade off session. There's sometimes like times where you can, but it's usually best for volatility reasons, and the market maker purposely does it at certain times. Okay, so here we had New York Open, we swept that. If we zoomed into that, we could have had a lower time frame entry from that point, which is what I did here, and then our target essentially is that phase one for this buying. So it's utilizing buying and selling, and not having a total bias when you have available zones. Okay. Now with this one, we got a refinement. You can go on the lower time frame to refine. I'd say the 5 minutes is usually best as the lowest, because you don't want to over refine and miss a trade. But we swept our inducement here. We came and we filled our imbalance with this move here. And then we reacted. We broke internal structure. You can go on a lower time frame, find an entry, and now we can target this one up here. So we can target the weak high. Why can we target the weak high? Well, like I said, when you have the mitigation cycle, everything becomes efficient and you can't re-mitigate something. So we have this high that mitigated to there, which mitigated to here, which now mitigated to here. We took advantage of this sell trade as a mitigation for buys as well. And then that mitigated to this point. So once this breaks, we know we're going to take the high because we don't want to re-mitigate a zone. You get small pullbacks like this because it uses slightly weaker zones a lot of the time. But more often than not, if you don't have a clean high time frame zone, like we don't here, because it's all being mitigated, you just run straight through it and you can target the weak high and get a really nice trade from there. So that's that order block selection. So that's really important to use those three rules. Like I mentioned, let's follow this line. So smart money traps. Smart money traps are very underrated in trading. Most people just say, "Oh, I'm not going to trade a smart money trap because they know it's a trap," and then they get it right. But if you think about it further, it's actually very important for targets as well. And I'll show you how. So the smart money trap here, essentially, this is a very nice looking order block. Okay, looks like it's mitigating all these buyers. You know, create that imbalance. It looks like a good a zone to use, but skipping forward in time, we liquidated it like very fast, completely, which means there was no banks that actually wanted to contribute to mitigating the demand zone at all. Okay. So this is the proper way to look at it. Okay. So we already mitigated our range by sweeping in its inducement. So if you think if you think of the idea that inducement belongs to zones, well, if you're seeing this here and you're seeing this build up here and then you're seeing this sweep, we can see this is a manipulation. Essentially what the banks have done, they've already taken the orders from this range here, and they've used, just because they haven't used this, they've used this whole thing here, and that's the very importance of a sweep, when you have that sweep and then that break, that push up. So we know that this zone is now a trap, because even though it didn't tap into it, it tapped into its entire range, and it utilized those buy orders already. So it doesn't need to do it again, because we don't want to re-mitigate zones, okay? So, like it says here, even though this looks like a good order block that follows our rules of imbalance and impulsion, we swept the zone's liquidity, ruling out that last rule of having inducement. So yeah, we have imbalance and impulsion, but if we don't have inducement, that's being able to be created. So we cannot re-mitigate a zone that has already been manipulated, okay? So let's do a kind of interactive one where you think this zone will work or not. So just type in the chat whether yes or no you think this zone will work or not, okay? 5 seconds. So we got yes, 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 and no. Anyone else have an opinion? Oh, so that's 3 to 1. Well, let's have a look. The answer is no, so whoever said no is right. And we can explain why here. So, like I said, there's no potential for inducement to be created for our zone, because we had that kind of demand area mitigated, and then we swept past it, okay? Now, because we swept past it here, well, there's no more price action here for more inducement to be created, okay? So we already grabbed the orders within that zone's range, okay? And we did not have inducement already created for that zone. So the best way to do that is, if you have this big impulsive move with imbalance, but you don't have any, close price action for that zone, you just draw a box here and it'll signify a kind of no inducement box, saying that the only way we're going to get inducement is if we run it and use another zone and use that as inducement, or we can create inducement. But in this case, we already swept and we already used it, so let's do another one. Will this zone work? Yes or no? Alright, 3 seconds. Got a yes and a yes. Okay, let's have a look. Yep, so this zone does work. So that was good, you guys picked that right. So why? Well, we swept the weak highs to mitigate our high volume order flow. If we have that strong sweep there, we have our manipulation up here, so that's important to note. A big factor is we didn't break this swing low. Usually you want to use order blocks that, break the low. But that's the power of inducement. We respected this inducement. We didn't flick past it. Like I said, we stayed under it. So you find that top horizontal part, and you draw a horizontal line. And if we stay under it and respect it, it's telling us that we're building up more and more orders without doing that sweep. Then we sweep up into our zone, wait for our lower time, confluences to do our entry, and then we create our final inducement stage, and then there's a very nice trade up in here which you could have sold from. So yeah, you guys are right on that one. Alright, we've got one more. Will this one work? Yes or no? 3 seconds. Yes, no, it's in the middle. Well, it's a bit of a tricky one, but it was no. It was closer. So why did this happen? Well, instead of using this as our POI, we actually used it as part of that inducement chain, okay? So that new inducement level was used rather than this one here. So why did that happen? Well, we swept that possible reversal inducement, so this stuff here, that mitigated, should belong to this, but we swept it, and then we respected a demand, meaning that this demand creating inducement for actual buyers from here. So it's really important that we have to be fully efficient if we actually want to look for sells. But in this case, we had an open order block, so we respected that. We used this, but we also used this because this mitigated that, and we had a nice open zone here. And it's just a wick, and that's where it can be very difficult to actually find the right order block. So as long as they follow our valid rules, you're good to go. As soon as we tapped into that, put our manipulation up here, and then we mitigated that manipulation, swept our phase 2 inducement, okay? So the power of manipulations, okay? So why is this, strategy actually so powerful? It's because it's the best way to find manipulations in the market. That's through inducement. The manipulations in the market are what create the large moves. So as soon as we take our liquidity, you can think of it as like fuel in the market, okay? The bank algorithm runs 80% of the entire market. If they're planning to make a large pip size move, they need to take out a certain amount of positions before they can do that. Traders like us need to act like this algorithm in order to understand what it's doing. If we can find the point of manipulation, we can trade directly from this, enabling us to trade alongside of them, yeah? So in this case, we just circled up a kind of AMD phase, which some of you probably know, but we swept here, we had that breaker structure, we had that imbalance in there, okay? Here, at this point, it's the start of that mitigation chain, okay, up here. So that's our phase 1 inducement, and we pull that out, okay? Now this accumulation phase, at the end, while we have that push to sweep our mitigation inducement, we have that change of character, okay? Or market structure shift in this case, both work. We have the manipulation up here, and then we have our phase 2 inducement, which is a lower time frame entry idea, and then we follow time and price, and we can have some trades through there. So it's about, spotting the accumulation, spotting that active order block as like, the trampoline in the sense that we can bounce off after our accumulation. And then that mitigation of that manipulation that takes out that phase, yeah. And then essentially before you're looking to take your trade, you got to tick off some things. So we got our AMD cycle here. We're following time and price because we're in London at this point. We got pro-bearish order flow, so our momentum is downwards, so we want to respect our momentum in that case. We have our valid order block as well. This has 3 rules, not 4. Apologies. We have a nice big sweep. We have some divergence, which is an extra confluence, and then targets. You always got to look at the targets as well. We have our last point demand here, which gets mitigated to here, which allows another sell opportunity. Okay. So people might recognize this as the AMD cycle. Okay, so you got your accumulation, manipulation, distribution, or expansion. And it's a great way to see the phases of the market. The two-phase theorem takes it a step deeper and more advanced for more precision. It utilizes this framework but breaks the market down into liquidity build-up, reversals, and continuations. So looking at this, our accumulation is our liquidity build-up, and it's where we don't want to trade. We don't want to trade in our accumulation because we know it's going to end up getting liquidated. You can, if this is 4 hour, it's very different, okay, because you can trade in the 5 minutes within this. But if you're a high time frame trader, or you're looking for a a higher probability, you got to wait for that manipulation, that strong manipulation wick, like that, okay? The main idea is to find a manipulation after those build-ups, like we did up there. We first need our two-phase reversal, then we can trade our inducement pullbacks, okay, until our next reversal zone. So this constantly cycles through the fractal time frame idea. In our next webinars, we'll dive deep into this idea. The structure will be theory, then application. So this is a few things we'll go over next time, because there's a lot more to it, okay? Especially if you want that entry precision, there's a lot more to it. But this is the best way to find your kind of order blocks. Our webinars will be 2 hours every week, so this will just be an hour and a half. And we'll work closely with everyone who joins as well. We'll share our markups and things like that. But here's a kind of idea of these three, and this is straight from the ebook. These three here, we got liquidity build-up, reversals, and continuations, okay? So this is what we'll usually see and how we can take advantage of it in the market. So in this case, we've got a bullish setup, so we have a demand here. We sweep that phase one, so that mitigation, that's already occurred. We sweep that mitigation past our imbalance into our zone. Then what we got to do, we got to break that last leg that creates that sweep, okay? It's very important, and we'll go over that another time, but that is a very important factor. If we break that last, valid order block there, we have our structural shift. We also have a vector level, which I'll go over soon, but essentially your vector level is that last point of, in this case, last point of supply. And it's very important how we react to our vector level, because it will determine whether we're creating weakness or we're creating strength. In this case, we grab that last point of supply that was responsible for that sweeping move, and we induce. We grab this demand here that had that shift, and we take out that liquidity, and then this is our trade here. So it's going through the funnel of having maybe a 1 hour order block down here to a 15-minute or a 5-minute, and then that 1 minute order block where we can look to take either our limit trade or our supply failure trade, okay? So when we have this inducement level, we have to break or mitigate down and induce our vector level that created the sweep. Doing this confirms our reversal manipulation. So if we always want to spot our manipulation, so if we're spotting it here, it's just here, just past this accumulation, okay? Once we have our two-phase reversal, which is something we have to go over in the future, and it's in very different forms, so there's a lot more to it with the two-phase reversal, but other than that, if we have our two-phase reversal, we can trade inducement pullback continuations, okay? So these are where we encounter supply areas that are still valid, okay, but aren't strong enough to create a reversal. So once again, it's seeing the market as build up, okay? Manipulation reversing, so manipulation reversal, okay? And then continuations, that's it. Same thing happens here. Once we reach a reversal zone, we have a reversal or an inducible pullback, like I said here. But yeah, we have a reversal. If we have a reversal in this case, we have continuations to our next reversal zone. And it's a constant pattern of reversals, continuations, and of course liquidity build-ups. But that's what the Asian session is really good for. It's really good for creating a level in which price can sweep to manipulate. Okay. So like I said, up here we can utilize the same idea. In this case, we can see it as a potential reversal zone. So we find that inducement for this zone down here. Wait until that manipulation gets confirmed. If it gets confirmed, we can trade sells from it. So it'll be something like this down here. Or then again, if we're just entering a pullback zone here, we've got to find that level that created this sweep. Okay. Say it's something like this. Maybe it's here. And then we can hit into it. Then we have to create inducement for this level as a pullback. And then we can trade from that manipulation. So the important thing is to find whether the manipulation's here for the reversal or whether it's somewhere down here for a continuation, okay? But if you can simplify it into 3 phases like this, it's a much better way to see the market. Okay. So this is a gold trade that I got like 3 days ago, 2 days ago, and posted in the Discord. But I wanted to go over it because it uses these principles really well. Okay. So like we have here, we have a nice order block. Why this one? Well, let's reiterate. The money started from down here, okay, and we moved it up. See how we have no inefficiencies? It's because we're moving up that money. Move up to this point, and we have that imbalance, which is our detachment. We have that imbalance. We grab that level at the end of the imbalance, and if it mitigates, okay, we can look at it as inducement. Okay, sometimes these levels won't be reversal inducement, okay, because sometimes we might take it out, mitigate this, and then reverse, and there's a few other things that determine that. But in this case, it followed our rules of being a reversal, okay? So this demand zone has impulsiveness because it carried those orders, has imbalance in there, and it has inducement that's just formed above that imbalance, okay? We also got to respect momentum because momentum is a very real thing in the market. Nothing just goes like this, up and down, up and down. We have to respect momentum. And we have to always see where we're reacting to currently. You can't just randomly look at lower time frame price. You have to connect the dots. That's why it's very important to start on the daily or the 4 hour, because we want to see the intention of what price is going to do currently, and everything is determined from the left, okay? So absolutely everything. Every current point is determined from the left. So if that means you have to go on the daily or the weekly to have a look at what's determining current price, you need to go back, okay? Always look what's happening to the left. The vector level, won't go too much over why this is a vector level, but this is the last valid order block that created the sweep of our zone, okay? So there would have been a mitigation inducement here, and this would have created that push up, and it's a valid order block as well, okay? So we either respect the vector level or you break it and reverse, but in this case we respected our higher time frame vector level. So that was the 1 hour, okay, of gold. We're currently here, so this is very current. Now this is a 5 minutes, okay. Some of this might look a bit confusing, but I just did everything that goes through, my mindset of how I trade, and just pick it apart, okay. So I just want to show you the position we're in right now. So we're actually in here, okay. So this is post tap at that vector level. So this is that vector level. This is the tap, okay. Now we had that sweep, that mitigation inducement sweep, that took it out there. We broke structure, so we had like a change of character, okay. But if we're zooming out of it, we have a vector level here, which is very important, telling us that this level is that last point of supply that's valid with the imbalance and has potential inducement here as well. So you really got to respect your vector level, and you can't trade until you reach that level. Probably get a little trade in here, but this was very late New York, which for me is like 3 AM, so it's not possible for me. But you can usually trade to this level, especially because it's an hour order block, okay? And you got a bit more wiggle room to do so on the lower time frame. But anyway, we had our manipulation. We broke structure. We carried those orders with this wick here. Here, this wick grabbed into the range, grabbed into this wick. This wick moved up. Here we had an order block. It doesn't show imbalance, and it doesn't sometimes until you go on the 1 minute. And that's where it can get a bit tricky, but if you go on the 1 minute, you can definitely find some imbalance in there. As long as we have a detachment, it's valid, okay? But we respected that, swept some internal inducement there. We broke structure, reacted to our vector level, which is that, that active supply zone. Now what's really important here is this point here. This point is responsible for mitigating the vector level, but it's also a 15-minute order block. Now, because I trade on the 1 minute, that means you need like this here, you need a mitigation from a 15-minute or a 5-minute order block. So in this case, it's a 15-minute order block. So you can look in the 1 minute, that's still valid. But you also want to follow your principles of time and price, okay? So we grab the vector level at this point. So this box here is telling us a 15-minute phase 1. Now why is it a 15-minute phase 1? Because we have that 15-minute order block, and then we can use our phase 1 and then our phase 2 for our entry. But it's also phase 2 for the 1 hour. See, this is our phase 1 for our 1 hour, but then this becomes our phase 2 for this point. But we only want to trade in the 1 minute, so then we can retreat this as a phase 1, and then we can look for our phase 2, okay? But we got a little checklist here of what happens for our 15-minute mitigation. So we got a build up. Build up's really important because it's telling us that we're starting to create liquidity. It's like a bunch of equal highs in this case. We're starting to create liquidity for targets. So if we're doing big sweeps and we're pushing down, we're not creating targets for price to move to give it room to push through. So it's really important you identify a build up before that move of the mitigation, okay? Vector level is created, which we'll fully go over in another lesson because it's super duper important. Inducement for our 15-minute order block, well yeah, we had a demand level, we had imbalance, so our detachment from the orders, which are here, okay? This mitigated this, it's good, because if we're mitigating our inducement, we're building up, this mitigated this mitigated this, we're building up a lot of early buyers. So these are all early buyers because we didn't mitigate our proper zone. As soon as we build them up, it's like a light that goes off for a bank. It's like, cool, we'll take all of those orders straight away because they didn't follow the rules or the principles. We tap into here, okay, and then we're in London now, so we can look to trade. So we have to go on a lower time frame after our 15-minute mitigation, which we do here. So I'll just tell you where we're at. So this wick is this point here, okay? So we had a change of character, an internal change of character. Because of this manipulation, which is here, we respected it, moved up, and then we mitigated our final vector level that's necessary. And now we're going into New York at this time here. We create that other layer of inducement for this order block. This order block was found on a higher time frame, but if something's not clean, like this, and in the ebook there's different types of order blocks you can utilize and visualize and how they work. But in this case, it doesn't look super clean, but we got that last wick before that move up, okay? And you got to be patient, you got to sit in your hands. And I think a lot of people here would have got liquidated because, unless they put their stop loss down here for sure, but this swept kind of what you could say is an inducement, but it didn't mitigate those orders, so it doesn't have potential, it doesn't have enough volume to be able to push up through that level, okay? Also, another big factor is time and price. Here is pre-New York. Pre-New York usually, not always, but usually is a time in which we can build more liquidity for that New York Open, okay? So in this case, it did exactly that. It created a demand that missed our order block. It mitigated it, and then we swept that. So we have our final 1 minute manipulation, okay? Now at this point, we can confirm our change of character as a market structure shift because it mitigated our vector level and then induced it. Now that's kind of complicated, and we'll go over that another time. But it's very important that you just, if you get this, it's not a market structure shift. You have to follow certain rules for there to be a market structure shift, okay? And in hindsight, it involves mitigating everything first, okay? Also in the ebook, there's a step-by-step for a reversal, how to trade a reversal, so you can follow that within here. But essentially, we're ticking the boxes after seeing our last bit of inducement here. This is on the 15 seconds. I like to trade on the 15 seconds. as that final confluence of confirmation. We had that 1 minute tap in. You got to wait for that supply failure, and then you can trade from that final mitigation, that final sweep. Okay. So now at this point we have our reversal. Okay. And if you remember what I said, you have reversals, you have liquidity build-ups, and you have continuations. Okay. So in this case, we have our reversal, so we can trade continuations until our next reversal target. So here we had our move, we have our original move, which is a really nice trade. Then we have a push-up, okay, and then we enter this pullback zone up here, if you can see. CPB is just catalyst for a pullback. It always has inducement level to be valid, so I got that inducement level here, the inducement mitigation level. And as soon as we break that level, we get that move down, and we look for that next demand, and that's kind of our pullback. But what happens here is that we have a hidden little demand here, okay? And what that did, that mitigated to there, and that's good news for us because we know it's not actually utilizing the reversal orders. This reversal's here, the reversal mitigated to here. We only really want to mitigate the reversals orders, okay? It's really important because that's where we know the volume came into the market. And especially later on New York, you want to really be patient for that, okay? So we're happy about this because we're seeing that the inducement is mitigating. So we're collecting more early buyers. And then we follow our IPV step by step, which is also in the ebook, where you have that sweep, tap into our demand, have our 1 minute vector level, respect the vector level, create inducement for this zone, and then you have your buy from there. Okay. So that was that gold trade. But other than that, it's all kind of using the same principle where you wait for your reversal, you have your pullbacks, and then you wait for your next reversal point. And it gets rid of that bias of buying and selling and that pressure of not knowing if you're doing something right or wrong. Okay? Cool. Do you guys have any questions so far, or? Yep, you have a question?
Um, so far, you're going well, but because it's so early in the morning, I'm so sleepy, can't even get a gist of everything.
You're so
But
sleepy?
yeah, but
No,
yeah,
that's okay.
everything is I trying to follow you, but I'm just dozing off once in a while. Um,
Yeah.
do okay. What I want to know, right? Okay, you said the market structure shift and the church is the same thing.
Yep, okay.
That's what you said.
They're not the same thing. No, they're different. You need. I'll go to the thing where it says that. Here you go. Yeah, so they're not the same thing. No, no, but they can
Okay.
be the same thing.
Okay. What's the difference between the both of them?
Okay, so when you go to change a character, simply put, it's that break of supply in this case that sweeps liquidity. So when you have that change of character, you have that influence of where price wants to reverse. So we have a supply failure within here, and then we have that sweep of liquidity. When you have a market structure shift, it's the confirmation of that shift in order flow. Just because you have a chock, right, it doesn't mean you have a switch in order flow where you're going to keep going up. Okay, this could be respected and then it could break through. So just because you have a change of character, it doesn't mean it's the same as a market structure shift, and that's where your vector level comes in. Um, but the vector level is a little bit more to explain. It takes a little bit more time. Um, so I won't explain too much of the vector level, but yeah, there's a way to find out whether your market structure shift becomes similar to the way a chock works. Okay.
Okay.
So I'll go into a few live examples of how this phase one works for our order block. Okay. Okay. So here, for example, we have an order block because we have not mitigated the body or the top wick. So that's really important to note. And then what happens is we have this level, which is getting respected. Okay, it gets respected again. As long as we stay under this level, we're happy. Okay. Here, this level gets broken. Okay. Once level, sorry, just echoing. Once a level gets broken, we have that shift in structure, because this is the last point to take out that level. Okay. Once we have that shift, we can confirm this as our manipulation here, and then we can mitigate our manipulation like that, and then we can look for a trade in here. In this case, our phase 2 would be in there, and that's utilizing that kind of order block strategy there.